Hi everyone, uh, welcome to Indigo Learns Amalgamation and Internal Reconstruction webinar part 2. Thanks a lot for staying patient. Yes, it's been a bit tricky with a few technical challenges here and there, but thanks for staying patient. We'll just wait for a couple of minutes and then we will get started with our session. Let's just give a couple of minutes for everybody to join in. Yeah, let's just give a couple of minutes, friends. Hi, Sridevi. Hi, Varun. Hello, hello, hello. In a minute, let us join in. We are giving time for our other friends to join. All right. So let's get started, friends. I hope all of you are doing well in these funny, tricky times. Uh, just keep me posted and share in the comments how you have been ensuring that you stay positive at the same time you stay safe. Just keep posting as to how you are taking care of yourself. All right, we wanted to have this session a bit sooner than what we actually are having, but due to some exceptional circumstances we haven't been able to do the session sooner. It's always fine. So we will now get to discuss about amalgamation and internal reconstruction. So how am I? Yeah, I'm doing pretty well. You're seeing me, right? So you're seeing me on the screen. Maybe I'm not able to see you, but I'm doing well. I'm doing well. All right. Now, just a quick recap from where we left earlier and what we accomplish in our today's session. We already discussed about key areas in purchase consideration discussion where students make mistakes in the examinations. In that, primarily there is one point which we are yet to cover. I want to cover that so that we can be fairly confident that we have covered the base. The thing is regarding choice of share price. Where does it come and how do we deal with the choice of share price? Okay, right. Um, all right, great. Now, with respect to the choice of share price, of course, is one thing we will discuss. Then we will talk about broadly the key areas where students make mistakes. Those are the riskier areas, right? In the journal entries part. So the ones we have to be careful about. Balance sheet tallying, honestly, I don't know why people just find it surprising or people find it such a challenge, but balance sheet of an amalgamation problem should generally tally whenever it is asked for. So that shouldn't be so much of a challenge. So, but still, I'll talk about one or two key things even with respect to that, and then we will go into internal reconstruction. And if anybody is in a great rush, come on, what are we really rushing towards? Let us enjoy our session on amalgamation and internal reconstruction. We will stay focused. I'm turning my phone into airplane mode. I hope you're also turning your phone into airplane mode. Please finish that so that we don't have any disturbance. Okay, right. Has everyone done that? Let's stay with full focus on this discussion. Right. Now, vanakkam, namaste, adab, in whatever language you wish I tell you hi. But now, thanks for all the compliments. Thanks for all the concern. I'm doing well. Let's now get into the subject. Right. with respect to the amalgamation purchase consideration discussion, what is the challenge in the share price related aspects? Okay, now let me take, I hope you are able to see if I am writing this. I think we have figured this out earlier. So what we will do is we will understand exactly how the share price related points can be confusing in the examination. Right? A lot of mistakes get made in the share price related calculations in the problem. Okay, right. Now, friends, here when we talk about swap ratio, we spoke last time. I think the point where the net got some challenges was regarding the share price calculation. So there are two companies. This is the example what we're talking. I brought the same 500 rupees note from our last time's discussion. Okay, right. I am the purchasing company. You are the selling company. All right. I'm the purchasing company. You are the selling company. In your company, the share price is 100 rupees. In my company, share price is 500 rupees. All right. Okay. Now, for every one share of your company, how many shares of my company should be given? Come on, quickly answer that. Your company share price is 100 rupees. My company share price is 500 rupees. I am the purchasing company or the selling company. For every one share of your company, how many shares of my company should I give you? Fast, fast, fast. Come on, come on. Please shoot those answers. Shoot those answers in the live chat. अच्छे बच्चे आप लोग. Okay. 500, 500, 500. Pratyusha, Deepak, 0.2, as agreed by both of you. Kya baat hai? Lovely. I just love, you know what? I really love this session because we get to hear probably more than what we hear in a physical classroom. We get to hear views from so many students. Right. Okay. Okay. Now, listen carefully, friends. In your company, the share price is 100 rupees. In my company, the share price is 500 rupees. When I asked, when my company is acquiring your company, for each share of your company, how many shares of my company should be given? I love the answer what Durga Ashwini gave. That's exactly what it is. Whatever we agreed upon. If we agreed upon that for every share in your company, I will give one share in my company. You may say, sir, what's wrong with you? For 100 rupees share, why are you giving 500 rupees? I badly want to buy that company. So friends, please understand, you don't get to determine as a student, you don't get to determine the value at which the transaction should take place. Right? You are solving an accounting problem where the value at which the transaction should take place ideally would already be determined by those parties. So the negotiation, if it was such that for every share in your company, I agree to give one share of my company, so be it. Maybe your company share is 100 rupees, my company share is 500 rupees, doesn't matter. If that is what you and I agreed upon, that will be final. I might even go overboard and say, for every one share in your company, I will give you 2 shares of my company. You may say, sir, that is one share, that is 100 rupees. Two shares means 2 into 500,000. Will you give 1,000 rupees worth? Possible, right? So that's also possible. Deals can happen in different ways. So my dear friends, first reflex. This is a very critical point. Your reflex generally will be you determining what the valuation, fair valuation should be. Please stay away from that immediate reflex. What should be done? Come on, I want to hear from everyone. What is the first preferred value that you will search for? For one share in your company, how many shares from my company should I give? Come on, what is the answer? What should be the first reflex? What should we look for? In our examination also, what should we look for? What should we look for? What should we look for? Pratisha wrote agreed value. Now Sridevi wrote agreed value. Right? That is good. That is good. That is good. Now agreed values More and more people are beginning to write agreed value, agreed value. Lovely, love you all. Okay, come on now, friends. Agreed value is the agreed price or agreed value. Basically, agreed, whatever is agreed between these two parties is the first one. Please register this very strongly. Excellent, excellent, excellent. Okay, right. Now pause. Pause here. Fine. I understood that you understood. Okay, right. Pause here. This is the first and foremost thing. Okay, right. Pause here. Okay. No more comments. Wait for a moment. Now come to the next one. What if in the question you just have that share price of your company is 100, share price of my company is 500, agreed value is not given. Agreed value is not given. If agreed value is not given, will you write in the exam paper agreed value not given or agreed ratio not given? So only when that is given, I will come back to write my exam. We can't do that, no? So then what should we do? In such cases, what should we consider as a swap ratio and proceed in our examination? 100 rupees is the share price of your company, 500 is the share price of my company. Agreed upon value is not given in the exam. First, we are looking for agreed value. That is not given in the exam. Then what do you look for? That is important. Then what do you look for, my dear friends? Come on, quickly post. We need to move forward with this topic. What should we look for? If the agreed value is not given, then what is the exchange ratio? As per share value. Sridevi, what share value are we talking about? Pratyusha Siram is saying market price, net asset price, assume share price, agreed value. We take market value, share value, 1:5. My friends, pause. The reason why we are discussing this point, intrinsic value, net asset value, share value, you understand why I am focusing on this so much? When you look at the comments of examiners historically, these are the areas where there are way too many mistakes. That is why we are putting this effort to understand. Okay, friends, please pause. Please pause. Okay, right. Target company by acquisition company, fair market value. Please pause. Okay, right. Now listen carefully. No more comments. Listen carefully. If the agreed upon value is not given, the next best value is the external value per share. What am I calling it? External value per share. External value per share is also called extrinsic value per share or market value per share. I'm repeating. First, we were looking for agreed upon value. If agreed upon value is available, excellent. If agreed upon value is not available, then we are looking for external value per share. External value per share is also called extrinsic value per share or market value per share. Okay. I'm doing a YouTube live. Okay. Can you give me some time? No, please. Okay. These are the challenges what we will start having in times like this when we have to do all these YouTube lives from home. Okay. I'm just going on mute. All right. That's my son. I guess you guys guessed him by now. He's Virat. All right. Now, with respect to the extrinsic or external value per share, I hope you got a sense of what it is. Now, market value, if it is available in the question, that will be your second most preferred valuation that you will consider. Market value, external value, extrinsic value are same. Okay, right. So, friends, now we spoke about the first one and second one. The first preferred and second preferred. First preferred is agreed upon value. Second preferred, if agreed upon value is not given, then the one that we choose is extrinsic or external or market value per share. Okay, right. Now, come to the third one. The third one, obviously you come to the third situation when the first and second are not possible. You don't have the agreed upon value. You don't have even the external or market value per share. So it is not available in the question. As simple as that, it is not available in the question. Then what do we do? Come on, tell me. Then what do we do? External value per share or market value per share is not given in the question. What is your third preference? I want to hear the answer for the third preference. Come on, keep pouring in the answers. Fast, fast, fast. 1 minute. Give out all your answers. Next is intrinsic net asset value, intrinsic net asset value, intrinsic net asset value. I'm confused. Should I follow intrinsic or net asset? It looks like these are the two options. Okay. Average of, what is this? Average of company 1 and company 2. Karthik, you will be given an award by Ministry of Finance for this innovation. Then one more answer, inherent value. Okay, right. Now, my dear friends, listen carefully. Right, Karthik, I was just joking. Right. Now, listen. The first one, second one are over. Now we are talking about the third option if the first and second are not available. If extrinsic value per share is not available, what we mean by that is something like, yes, I was just trying to make sure all the things that I had for our earlier session, we had even for this. Now, listen carefully, my dear friends. Okay, listen. Now stop. No commenting. Concentrate on this. If there is something written as price for this box, we call that price as the market price for the box. Okay, we can call that as the market price for the box. Similarly, for the share, you may have for the share a value at which it is being traded that you will have in the question. Okay, right. What if that value is not given to you in the question? If that value is not given to you in the question, what you do is something like this. Concentrate, please concentrate. For some clarity, can you tell us why we are searching for those values? Rama Sesha Gopal, we are searching for that because without that we can't do purchase consideration. If we don't know how to do purchase consideration, we can't solve amalgamation problem. So we are becoming awesome at calculating purchase consideration. Come on, listen carefully. Now what we are doing is, in the third option, we are basically opening the box called net assets. Somebody was talking about that. Okay. We are opening the box called net assets. There is one box for purchasing company. There is another box like this for selling company. We are opening the box. Now concentrate very carefully. In this box, I found some assets. Okay, right. I take this asset and earlier I tried to find for box as a whole, is there a market value? I couldn't find for box as a whole the market value. Now I find this blue pen. I will look for the market price of this blue pen. Understand this carefully. We have to become chartered accountants that will be useful to the world, not the chartered accountants that the world will be ashamed of. So for that, we have to know the concepts perfectly, right? So you are at the right place. You are at Indigo Learn. You are learning this concept. So you have to have the patience to understand these important technical aspects. Then you can do great in exams and also in your real life. So here what we are doing is, in the third option, we are opening the box. We found the assets which are there in the box. Now we are saying, for this asset, what is the market value? I found for this asset, the market value is some 100. Then I took another asset. What is the market value? 150. Say in the same box, there is a liability also. Okay. For this liability, what is the value? Some 20, 30, whatever. So assets minus liabilities. At what value am I considering? Assets at the value, at the external market value of individual assets minus, if this is a liability, settlement value of the liability. I'm subtracting the settlement value of liability, and we are saying, say, purchasing company's worth is 100, selling company's worth is 50. Okay, for example, purchasing company's worth is 100, selling company's worth is 50. Then we will basically say, oh, net assets. What did we calculate? Net assets of the purchasing company, net asset value of purchasing company. Net asset value means assets minus liabilities. Net asset value of purchasing company considering the external value of assets. Are, sir, till now you said intrinsic value. Suddenly again you are going extrinsic. Are, beta, suno. Listen, what are we doing here? We don't have a market price for this share. That's fine. We are opening the box and trying to calculate for each asset what is the external value of each asset. Is the external value by disposes of what is the value of this asset minus value of any settlement value of liabilities. That will give us a sense of, oh, today's worth of this company, purchasing company is 100, today's worth of selling company is 50. Okay, divided by the number of shares, then you will get value per share. You will divide that and get the value per share. Friends, are you clear about it? So how did we try doing in the third calculation? We considered the net asset value. Yes, net asset value only. In net asset value, for assets, we tried arriving at the external value or the value at which those could be traded. Okay, then minus liabilities. Liabilities at what value? Liabilities at their settlement value. Assets minus liabilities, net assets. Now you got in the third option net assets at their settlement at the values which we can reasonably say this is intrinsic. Okay, right. Now you may ask me, sir, after arriving at the value, why did you divide number of shares? I want the per share value. I want per share value to decide what is the swap ratio. So for that purpose, I tried arriving at per share value. Say, for example, after all these calculations, I got purchasing company share is worth 2 rupees, selling company share is worth 1 rupee. Then what do I do? For every 2 shares of the selling company, I might give 1 share of the purchasing company. So suddenly what is happening is, in a case where the agreed upon ratio is not given to you in the exam, you are becoming the Dharmraj. You are becoming the person who is determining the reasonable value at which the transaction should be settled. Okay, right. So I want to pause here and I want to check, has everybody understood the first 3 bases for purchase for determining the share price? Our agreed upon value, then extrinsic or market value, then intrinsic or net asset value. Has everybody understood this? Yes, sir. That's so delightful to see this. Okay, Karthik, first one is basically agreed upon value. Whatever we both agreed upon, we can agree upon. Saying for every share of your company, I'll give 1 share. For every 5 shares, I'll give 1 share. Or for every 1 share, I'll give 5 shares. Whatever we agree upon, that is the first one. Okay. The third one, we said net asset value. Just now we discussed. Okay, right. More explanation on the second case. Okay. Second case, what we said, it is the market value per share. Whatever is given in the market, that is the external or extrinsic. That is the second one, extrinsic value. Share price, market value of share. Okay. The third one. Okay. Now concentrate carefully. Now there is a small variant to the third one which we will understand. The third option is basically net asset value or intrinsic value. Intrinsic value, how many of you understood this concept of, oh, in intrinsic value also, when we say intrinsic value, we have to, in intrinsic value also, we have to understand the intrinsic value by taking the net assets and arriving at their extrinsic value. How many of you understood this concept for the first time? Okay, right. Fine. Now we will move into the next aspect of discussion. In the third one, now we will have a small variant. The variant is, if ideally, okay, right. Good, understood. Right. Now, for the third one, what if for these assets, there is no What if for these assets, there is no external value given to you? This asset, external value, if it is not given to you, then what do? I look at this asset. Hey, which value should I take? This value, this asset's external value is not given. Then for these assets, which value should I consider for intrinsic value computation? Can anybody tell me? Book value. Two answers I got till now. Book value, you're saying. Book value. Sir, when will we use net asset method? Beta, net asset value method you will use when the first two are not possible. Okay, right. External value, agreed upon value is not there. External value per share is not there. That is when you come to this. Everybody is saying book value. You are right. I will try to find you and say net book value. Okay, what is the net book value of this asset? The carrying amount of this asset. What is the net book value or carrying amount of this asset? At that value means the value at which assets. Net book value, I'm assuming when you said book value, your bhavna must be net book value only. Okay, but I'm just being explicit. At net book value or the carrying amount of asset, you have to consider what is carrying amount of asset minus cost minus its accumulated depreciation. At that value, you will consider. If it is liability, generally you will consider that liability at the value at which it is recorded and carried in the books. Okay, right. So now I think we are fairly clear about the third one. The third one is intrinsic value method. Okay, right. So first three are over. In the third one, we did both the variants where ideally we want to take for these assets the external value, and for if external value is not available, we have to consider the net book value. Right. Now come to the fourth one. If first three are not available, then you may come to something called, you may wonder, sir, do we really have problems in our examinations till now where the first three were not possible, were not available? Generally, no. Why? Agreed upon value should be given in the question. Market price per share should be given in the question. You can't determine the market price per share just like that. Okay, generally it will be given in the question. If these two are not available, third option, you will calculate using net asset method or intrinsic value method, where preferably with the external values of these assets. If that is not available, with the book values of the net book values of those assets, you will calculate that. So that way, your examination options will normally end here. If for any reason this is also not available, then maybe you might go for the paid up value of share. If that is also not available, face value of share. So, but I would say these two are largely theoretical. But what is important is I want to hear from you people before I move into the next aspect. We will now close the discussion on purchase consideration. But before I move ahead, for share price, quickly tell me what is the sequence in which you will select the share price. What is the first one we spoke about? Second one, third one. Type all three at once in your comments. First preference, second preference, third preference. Okay, very good. Okay. Wonderful, wonderful. I'm very convinced now that you people will get these share values right. Okay, right. So, right now let us put a pin on this. Let us move to the next aspect. Okay, wonderful, my dear friends. I'm very proud of you all. You really understood the way to choose the share price, and if you know how to do that, then again, that's a very important aspect of getting the purchase consideration, right? So I'm convinced with your level of understanding. Okay, right. Now put a pin on that. Pause. We will talk about the, besides purchase consideration, when it comes to journal entries, what are the main areas where students make mistakes in the examination. For this, I remember, I think it was a few years ago, I spoke to 7 or 8 examiners who corrected answers. There are 3 of my friends based out of Bombay who used to correct exam papers, and a couple of them in Chennai, then one person in Nagpur. Like this, I took a basket or kind of a group of those people and I tried understanding chapter wise where are the common areas of mistake. In fact, you would have noticed even in our video classes, I'll focus much more on some specific areas because those are those googlies which examiner throws at you. If you know how to deal with those googlies, then rest of it is fairly okay, right? One of the things besides purchase consideration where those people shared with me that students make mistakes is when it comes to the journal entries. Somehow this business purchase, then business purchase account getting closed, not getting closed. Somewhere I heard people make mistakes. I like, why do people make mistakes? Then the answer is, when I thought about it, I realized people never understood the core logic why that accounting entry is coming in. And if you understand the core logic of that accounting entry, which might take 5 to 10 minutes, you can't make mistakes in that. Okay, right. Now please listen. I'm not solving all the problems of amalgamation here. These are meant to be special sessions to ensure that the possible thorns which might be there in the exam hall, you will be more mindful when you are solving those. Okay, right. Now listen, concentrate carefully. I go to a shop, I want to purchase a television. I went and purchased a television. What is the journal entry I write? If television is a fixed asset in my books. Okay, television is a fixed asset, television account debited. 2, if I paid money to cash or bank. Okay, so fixed asset television to cash or bank. I went to shop to purchase shop. What? I went to the shop to purchase a shop. So I went to the television shop not to buy a television, but I went to the television shop to buy the shop. So like shop. Okay, so this is like I purchased the business, right? I purchased the business, the entire business I purchased. So business purchase account debited to bank or cash or bank if I made payment. Okay, so if I purchase television, fixed asset television purchased to cash or bank. If I purchase shop, the entire business if I purchase, it is business purchase account debited to cash or bank if I make payment. But hold on, if I don't make payment for television purchase, what entry will I write? Television purchase, basically fixed asset account debited to the shopkeeper, right? To the shopkeeper or creditor. I'll simply call that person creditor. Apply the same analogy here. You're purchasing business purchase account debited to whom are you calling as that creditor? The creditor, basically, when you are purchasing business, is the liquidator of that company. Liquidator of the company is the person to whom I have to make this payment, after which they will make the settlements internally. So that is what we need to bear in mind. Okay, right. So business purchase to liquidator. Now concentrate carefully. Business purchase to liquidator. So business, again, like that example what I spoke about, say this is a big box. Okay, this is a big box or small box, whatever, doesn't matter. First let me fix the box. Yes, okay, this is the business that I purchased. Okay, now I open the box. Next entry, I open the box. When I open the box, I got, oh, land, acha, oh, building. Okay, right. Like this, all other assets. So earlier, this as one asset, whatever I purchased, now I open the box, and after all these assets are removed from the box, this box is waste. I'll throw it. So the earlier that business purchase, whatever we accounted, that should be credited. No, because that business purchase is this khali dabba in which everything was there. A dabba in which all these items were there. Now, in the second journal entry, I remove all these items and I throw this dabba. All these assets now come to life separately in our books. Assets, liabilities, etc. come to light separately in our books. Now, my dear friends, please concentrate. Here, in the second entry, liquidator will not come. Please don't make that mistake. In the second entry, again, liquidator will not come. Why will liquidator not come? See, in the first entry, business purchase to liquidator happened. In the second entry's main purpose is opening the box. Opening the box means this box, business purchase will be credited. All these assets, debit what comes in, basics of accounting, all these assets will now be debited and recorded in our books of account. Did you understand this? So, and of course, purchase consideration already came in because this business purchase, when you credited, obviously that is getting considered. Okay, right. Now, you opened all these assets, liabilities. If there is any difference, goodwill, capital reserve, you will record. That I'm not going into the depth here. That is a fairly simple point. Now, the next thing is, after this, with the second entry, this box, khali box, went into dustbin. In first entry, I debited, second entry, I credited. So, this khali box went into dustbin now. So, business purchase account is closed. Kindly, for God's sake, don't bring it up again. Now, when we talk about liquidator settlement, in the first entry, basically there was a creditor. The liquidator is the creditor, right? So that liquidator, who is the creditor, basically later for TV, whatever I purchased, if I have to make payment, creditor to cash or bank. That's what we will do when you make the payment to the creditor. Here, that liquidator is being settled. When you are settling the liquidator, what is the journal entry you should write? Liquidator account debited. I'm talking about the journal entry for settlement of liquidator. Liquidator account debited to liquidator account debited to, if you are paying in the form of cash, to cash. If you are paying in the form of shares, to shares. If you are paying in the form of debentures, to debentures. In whatever form you are making the payment. Please don't bring business purchase account. Business purchase account is already over. That is debited, credited. The business purchase account is dead. Okay. Please don't bring it up again. In liquidator settlement, creditor to cash or bank you would have written. Instead of creditor, you are writing liquidator to cash or bank for the amount of cash or bank what you are paying. If you are giving equity shares, to preference shares, to debentures, whatever you are giving. Just that if you are giving equity shares, the issuer of equity share has to break it up. Issuer of equity share has to break it up. Very important point. Be careful. Has to break it up if there is a securities premium portion. To equity shares, to securities premium. Again, to preference share capital, whatever, 8%, 10%, whatever you will write. Preference share capital, to securities premium. So, don't simply say to equity shares. No, to equity share capital. Because when you are giving, please don't write to equity shares alone. No, that's not enough. To equity share capital. Because here, for the company which is issuing these shares, it is going and sitting in the capital. It is not your investment. It is sitting in the capital and liability side of balance sheet, right? So you have to consider it specifically. Okay, right. And by the way, there is no business purchase coming here. With this, what will happen? Liquidator account also will be settled. And be careful whenever you are passing journal entry for liquidator account. One, you are not bringing business purchase again. Two, for the shares, you will constantly check for the language. You are writing it as to equity share capital, to preference share capital, and you are splitting. The third point is you will check whether there is any securities premium portion in those. Is everybody clear about this other important adjustment regarding important discussion regarding journal entries? We finished that in about 8 minutes, not even 10 minutes. Okay, I want to hear from everyone. Is everybody absolutely clear about this? How do you find this? Is it clear? All right. Wonderful. Okay, now that's about the discussion that I wish to have regarding the journal entries. There are many more smaller aspects which we can go on and on, but that's not in the best interest of our time now. So here, let's now talk about a couple of points when it comes to balance sheet. Friends, please remember, to tally the balance sheet of an amalgamation problem, you don't require to be a genius. But if you want to not tally it, you need to do something spectacular. Otherwise, it is difficult to not tally the balance sheet in an amalgamation problem. I'm repeating. In an amalgamation problem, a person who is genius only can not tally the balance sheet. By all ordinary means, the balance sheet will automatically be tallied. Okay, so kindly don't show your genius when it comes to balance sheet. You can happily, normally, easily tally this. अरे वरुण ठाकुर लास्ट लाइन रिपीट बोले तो क्या रिपीट करूं भाई? You have to do a spectacular mistake to ensure that the balance sheet is not tallied. Otherwise, balance sheet will automatically be tallied. Okay, so that's what I'm talking about. Joke को बार बार repeat करने में मजा नहीं आता यार. Anyway, right now, moving ahead, I will encourage you to remember 3 basics when you are tallying the balance sheet. Of course, I'm talking about purchasing company. Almost 90% of the times, you will be asked to prepare balance sheet of purchasing company, correct? Will you be asked to prepare the balance sheet of selling company also after amalgamation? Did you people ever solve? Did you guys ever solve problems? Prepare balance sheet of selling company after amalgamation? Anybody solved? I just want to know. I mean, why should learning just be one way? Learning could be both ways, where you can tell me, sir, I made mistake in my last attempt. Ravi Shastri, don't make that mistake, my friend. No. After selling company is amalgamated, selling company mein bacha kya, right? So there is nothing left in the selling company. So for nothing, do not prepare a balance sheet. It will give you nothing. Okay, right? So there is no question of preparing balance sheet in the books of selling company after amalgamation. So if we are talking about preparing balance sheet, we are generally talking about balance sheet in the books of the purchasing company, right? So that is given, right? Now concentrate. In the balance sheet of purchasing company, 3 important points you just have to bear in mind. Whatever assets and liabilities, capital assets, liabilities that are already there in the purchasing company, first think about it. I'm talking about there are 3 important points in that. The first important point for balance sheet: what would change in the balance sheet of purchasing company, or in the items which were there in the balance sheet of purchasing company? Share capital may increase, right? Share capital may increase. Then reserves, there can be some securities premium, capital reserve, things like that which may come in, right? So like that, there can be changes in the share capital. If the selling company, if the purchasing company issued debentures in this process, maybe to settle the debenture holders of selling company, we issue debentures. Then there can be some debentures which might be changed in the purchasing company. Then if there are any if there is anything like intercompany balance, those intercompany balances might undergo change, right? Intercompany, this company had a payable, that company had a receivable. Those 2 things you might want to knock off. Just remember one small point there. You will have to do those intercompany knockoffs at what point? After you incorporate the assets and liabilities from the selling company, only then you can knock off the intercompany balances. You may ask me, sir, what is this? There is a debtor, there is a creditor. Debtor in the books of one company, creditor in the books of other company. We talk about intercompany balances or mutual owings which you are cancelling. To cancel mutual owings, both have to come under one umbrella. You have to bring both under one umbrella and then say, hey, now it doesn't make any sense to have a receivable and payable. I want to just knock it off. Okay, for you to say that, both need to come under one umbrella. Okay, so that is why only after incorporating the assets and liabilities you do that knock off. Okay, right, keep it aside. Now with respect to the purchasing company, in the liability side, capital and liability side, these are the general points where you might see changes. If there is any amalgamation related statutory reserves, can anybody tell me if there are some statutory reserves in the selling company, will they come into purchasing company? I am repeating the question. if there are any statutory reserves in the selling company, will they come into purchasing company? Will they? If there are any statutory reserves in the selling company, will they come into the purchasing company? Oh my God. No, sir. Debenture redemption reserve account, sir. Yes, sir. No. Yes. I think I definitely need to drink some water before answering this question. You know what? These webinars are a great reflection of the areas where students have different views. You have like 15 people writing 15 different answers sometimes. In both the methods, there will be transfer of statutory reserves. Balakrishna, no, but only in the nature of merger. Okay, I will give time till end of this webinar. I will give time. You have to think about it and answer properly. Statutory reserves, will they come into the books of into the balance sheet of purchasing company after on account of amalgamation? You think about it. We will conclude our webinar only after answering this question. But I think there are answers all over. Just think peacefully about it and answer. Okay, right? I am not giving away the answer right now, but I will talk about the answer in some time. Right. So on the asset side, all the assets what normally purchasing company had prior to amalgamation, those things may continue. If there is any intercompany balance that knocking off, we already spoke about. Any cash payments, if they are made, the cash will go out. Cash or bank account, that will go out. Okay, right. So first we are trying to understand what will happen broadly to the assets and liabilities and capitals of the purchasing company. We had a broad understanding. The second one, like in 5 minutes, we'll complete this discussion regarding balance sheet also, right? Amalgamation adjustment reserves. Oh, amalgamation adjustment reserves will be reflected in the purchasing company. Okay, right. No, sir, they will come only in case of merger. Please pause your comments. I will come back to that. See, just look at this. There are more than 15-20 people who answered in a very different way. Everybody's answer is different. When the question was, will statutory reserves appear in the books of purchasing company after amalgamation? That was my question. Okay, so for that we have a huge list of answers, right? Okay, now I'll respond to it, but hold on. Don't type the answer right now. Towards the end, I'll give you time once again. You can share your response. Right now, the second aspect in the balance sheet is just understand, because of selling companies' net assets being taken over, what were the assets, liabilities, etc., which got created. So particularly the second journal entry, right? Particularly the second journal entry where assets and liabilities which were incorporated from the selling company, including goodwill, capital reserve, if any. So those items should definitely come into the books of purchasing company after the amalgamation, right? So particularly I am talking about the second journal entry, that is after business purchase to liquidator. We are talking about all assets to liabilities to business purchase, etc. So that big journal entry, what you would write, from that journal entry you have to pick and put those assets and liabilities at appropriate places. Okay, right. Of course, also as a part of that, in the entries regarding settlement of liquidator, there will be effect. Settlement of liquidator, when you're talking about, there will be effect in which account? There might be effect in the cash payments. There might be effect in the equity share capital, preference share capital, or securities premium. So in those places there might be effect. Okay, right. The third point what you have to bear in mind is these adjustments like intercompany balance and all, whatever adjustments are happening, those three things you need to consider. Friends, honestly, if you peacefully look at how these items are coming in, first, if you just carefully think about these three aspects, you will generally have the balance sheet tied up. And I would encourage you to do this. Whenever you notice that your balance sheet doesn't tally, please write down the reason why your balance sheet did not tally. I'm repeating. Whenever your balance sheet doesn't tally, just write down the reason. Why did balance sheet not tally? After you figure out, write down the reason. You will realize it is very casual, careless mistake that we do from our side for balance sheet not to tally. Otherwise, balance sheet is meant to balance, and you will generally have, particularly for amalgamation problems, peacefully the balance sheet should tally. Even if it doesn't tally, don't get stressed here. Just come back to the journal entries, look at the journal entries, look at the balance sheet of purchasing company. One small thing, when you are taking the items from the balance sheet of purchasing company, you have purchasing company's column, selling company's column. Please don't make the mistake of taking items directly from selling company. You have to correctly take the balances from the purchasing company, etc. Okay, right. So with simple things, your balance sheet should normally tally. Okay, right. I think our friends are just not able to get over that amalgamation, adjustment, statutory reserves and all. Let me see. I want to close that. Otherwise, people are not concentrating on what we're discussing. Vijay Amritraj is saying amalgamation adjustment account debited to statutory reserves in case of amalgamation in the nature of purchase. Okay. Amalgamation adjustment account debited to statutory reserves for incorporating statutory reserves in the books of purchasing company, blah, blah, blah. This is what Surendra Suraj Aju is saying. Okay, great. Love this answer. This is right. Friends, just look at the answer what Vijay and Surendra Suraj Aju gave. Those are correct answers, whatever they gave. And please understand, we need to be thorough with our concepts. Some people were wondering, sir, why are you asking all these small, simple questions? We already knew these questions. Why are you wasting the time in webinar? You are seeing for yourself. When I'm asking those questions, we have like 10, 20 answers. But finally, after some time, we are getting to see the correct answers. Okay, so amalgamation adjustment reserve karke kuch nahi hai bhai. There is nothing called amalgamation adjustment reserve. Some people were saying that. No, there is nothing called amalgamation adjustment reserve. You will incorporate the statutory reserves and correspondingly you will create. See, the point is this. After all the other journal entries for amalgamation nature of purchase are done, towards the end we will incorporate the statutory reserves. So suddenly statutory reserve comes and this side of the balance sheet, your capital and liability side of balance sheet, there will be an increase. Correspondingly on asset side, there is no increase. So there is no, what should I write? We will just write something called amalgamation adjustment account. Okay. So that is how we are supposed to do this. Okay. So there is statutory reserve on the capital and liability side, and there is amalgamation adjustment account, which is a non-current asset. We will write under other non-current assets. We will write amalgamation adjustment account. Okay. Is everybody clear about statutory reserves? How it has to be done in amalgamation in the nature of purchase? Is everybody clear about this now? Salman Bhai says, no, sir, I'm not clear about it. So, no, we are saying the statutory reserve will come into reserves and all the other journal entries you should have finished. Okay. After that comes statutory reserve. In that entry, you are basically bringing those reserves. Okay. I'm repeating once more. Listen. We are talking about amalgamation in the nature of purchase. All other journal entries should have been completed by then. Only then you come to statutory reserve. Why the hell are we coming to statutory reserve? Given a free choice, statutory reserve is not something we want to write. It does not make sense. But if you don't write that statutory reserve, there is a complication. There are some problems in the income tax. That is why we will still hold on to the statutory reserves. Okay. So when you hold on to the statutory reserve, the key point what I'm saying is, yes, you will have statutory reserve. Correspondingly, statutory reserve will come into reserves and surplus. Okay. Now, correspondingly, if this is 100, suddenly all journal entries are over, balance sheet already tallied. In a tallied balance sheet, say, I suddenly bring statutory reserve 100. In a tallied balance sheet, I am just adding on capital and reserve side, statutory reserve 100. Suddenly, balance sheet will not tally, right? Because there is extra 100 here. Correspondingly, there has to be 100. What will that 100 be? That 100 will be called as amalgamation adjustment account. It will appear under non-current assets, other non-current assets. More precisely, it will appear there. Okay, so this is how you deal with the statutory reserves in amalgamation in the nature of purchase. Is it clear to everyone now? Wonderful, wonderful, wonderful. There is something that I really miss. Something really I miss in the class. In a class like this, when students have a doubt, there will be an expression on the face. That expression on the face will be, I'll try to mimic it, like, something like this. They'll be just hearing it. Then in a physical classroom, you kind of figure it out that there is something that they haven't understood. And then you repeat the concept sometimes, and then they get it. Between not knowing and knowing, there will be a smile that comes on the face of a student. Honestly, I'm addicted to that smile. When a student suddenly says, "Oh, understood, sir." That moment is magical. That moment is so wonderful and so pleasant to see. So maybe in a digital setting, I wish sometime we figure out a way to know, that transition between you not knowing to you knowing. That's quite fantastic. Okay, right. So now I think we are fairly done with the concepts regarding amalgamation. Now I want to talk about a few aspects regarding internal reconstruction. Okay, right. Now I want to understand from you people, in internal reconstruction, are there any specific areas that you want help in? Why are we getting statutory reserves? Pawan, we are getting statutory reserves because not for accounting reasons. Accounting standard was never in favor of getting the statutory reserves in amalgamation in the nature of purchase. But if you don't carry those statutory reserves, there are some tax benefits and tax norms for which you need to carry that reserve for this much period, etc. If under amalgamation, suddenly that reserve doesn't come, the company will have a new tax burden. Now companies are like, just because I'm doing some accounting, I can't afford to have tax burden. So how do I not have the tax burden? So there is a little complicated story behind that. But anyway, it is basically to keep the tax authorities happy that a statutory reserve, which was supposed to be continued for X number of years as per the income tax, to ensure that it is continuing, you maintain the statutory reserve. Okay, right. So that is the little background to that aspect. Okay, right. Now I'm just asking you guys, in internal reconstruction specifically, capital reserve account, if capital reserve account balancing figure come is in debit side. Hey, Achyuta, normally if it is a debit balance, then you don't call it negative debit balance in capital reserve, you call it as goodwill. Okay, right. Okay. Is this beginning lecture? Varun, this is the second lecture on amalgamation and the beginning lecture for internal reconstruction. Okay, right. Capital reduction account balancing figure in internal reconstruction. Acha, okay, right. Thank you. Okay, right. Amalgamation adjustment should be disclosed. Right. Hey, miscellaneous assets and all, it is all old treatment. Forget that. Okay, right. Adjustments in internal reconstruction. I will do whatever I already planned to do, but I'm just asking you people if there are any special areas where you are looking for help. Okay. Otherwise, I will continue, with the adjustments which I already wanted to discuss with you people. If you have a problem in any specific areas, I wanted to prioritize covering those points also. That is why I'm asking. Okay, just be patient and just drop those points. Adjustments in internal reconstruction, somebody is saying. Okay, right. Is this beginning lecture? अरे वरुण भाई आप इतने बार क्यों पूछते हो? Same question. Varun, beginning lecture for internal reconstruction, second lecture for amalgamation. Yeah. Okay. Okay, right. Now, important areas which related to internal reconstruction. Okay, right. Okay, right, fine. So what I'll do is I will, if everybody has study material, quickly go and get your study material. Okay, that might probably help you. We can look at some adjustments. Quickly get your study material. Do you people have access to study material? Is there something called study material that, do you know that there's something called study material of ICI? Quickly get that if you have. Okay. Acha, Varun, you're studying BCom. आप तो chance पे dance मार रहे हो. You are studying for BCom at CA level. Okay, right. Now, let me talk about some specific adjustments. I am talking about illustration 3 in the study material. For those of you who do not have access to that, I am just sharing the link. You can probably refer to ICAI's link for study material. Okay, right. Now, please come to page number 6.11. We have illustration 3. Okay, right. We will go through illustration 3. I find that this is a good problem for us to get an overall understanding of the concepts of internal reconstruction. Right. We will and reduced. Karthik. Now, listen carefully, friends. Maybe we will take about 20 minutes or so, 20 minutes to half an hour, something in that range. Is it okay if we just stretch by 20 minutes to half an hour? Okay. Right. Now, please pay attention. We will understand through this problem the overall concept of internal reconstruction. It will be a good revision. All the concepts will get reinforced, and we will make sure not just this problem, but also the problems which are there in other examples. You will be able to solve all those. Okay, right. Now, please concentrate carefully. I'm going through this. So you have a balance sheet of A & Company as on 31st December 2000X1. So I'm just broadly skimming through the balance sheet, assets, liabilities, then you have some capitals and all. Okay, right. I'll skim through that and come to the adjustments. The court approved a scheme of reorganization. Stop here. Why did I just skim through that? Friends, even in examination, going into the balance sheet, reading number by number at this moment may not be of much help. So you just broadly see what's there, and then but mainly start looking at adjustments. With each adjustment, again go back to the item in the balance sheet and get a good sense of what is there in the balance sheet. Okay, right. The first one, court approved scheme of reorganization to take effect from 1/1/2000X1, whereby preference shares to be written down to 75 each and equity shares to ₹2 each. Stop here. Question number 3, illustration 3. Okay, right, illustration 3. Now, please concentrate. One common mistake that students make is reduced to reduced by. We get confused between these two. Pay attention. 10 rupees is the share value. 10 rupees share is reduced to 3 rupees. 10 rupees share is reduced to 3 rupees. 10 rupees share is reduced by 7 rupees. Okay, right. So it's not that we don't know this. A lot of times in the exam, what we know also we don't probably apply the right way. The reason why I'm emphasizing on those points in this session is to make sure you don't make those mistakes. As simple as that. So watch out when you're reading a problem. Is it given as reduced to or written down to or written down by? That we need to be careful. Okay, right. So now when I see this point regarding preference shares, I will go back to the question. preference shares are written down to 75. Now I'll go back. Acha, preference shares of 100 rupees. So 100 rupees, 100 rupees written off 275 means how much amount did we write off? Did we write off 75 or did we write off 25? Did we write off 75 or did we write off 25? How much did we write off? I think 75, right? Correct? We wrote off 75. Did we write off 75 or did we write off 25? Here, all such intelligent students are listening to this class. So, you're right. We wrote off 25 and we got to 75. Okay, right. Now, okay, right. Varun, it is written off. It's not 75, it is 25. Okay, written down 275 each. Written down 275 means from 100 you got it to 75. To bring 100 to 75, you should have written off 25. Okay, that is the small point. Just be careful. Okay, when you're dealing with this. Now, stop here. What is the journal entry pass? It's basically to this extent of 25, 25% of preference shares. Basically, preference shareholders are losing. Okay, preference shareholders are losing. And where is this going to get transferred to? It will be transferred to. It will be. Oh wait, the system says my connection is unstable. Are you able to hear me? Are you able to hear me? I am getting an alert here that internet is unstable. Are you able to hear me? I am getting an alert here that internet is unstable. Are you able to hear me? I'm not getting any response here. Okay, okay. That alert is gone. Okay, okay. Cool, cool. All right, all right. Thanks, thanks. Okay, that alert is gone. Voice is not stable, sir. But with a lot of buffering. Okay. Okay, all right. Let us resume. Now, when there is a preference share capital in the balance sheet, you find preference share capital is currently at 4 lakhs. So, a simple calculation, what we can do is if 100, please inform us before getting into live. If you have Pavanteja, if you have FinApp, our OneFin app, then in our OneFin app, you clearly get a notification regarding this. So you shouldn't have a challenge. Okay, right. Now, friends, when we talk about the preference shareholder reducing their claim from 100 rupees to 75 rupees, what is the way in which we should approach this? If 100 is comparable to 4 lakhs, 75 is still there, 25 is gone, 75 is how much? 25 is how much? So simple cross multiplication. So out of 4 lakhs, 75 means 3 lakhs is still intact, 1 lakh is reduced. That reduction of preference shareholders will go into an account called capital reduction. Okay, it will go into an account called capital reduction. It is also called, as Anand Kumar is saying, it is also called as internal reconstruction account, capital reduction account or internal reconstruction account. So what will be the journal entry here? As you see, out of 4 lakhs, you will try 6% preference shares account debited 4 lakhs to capital reduction 1 lakh to preference share capital 3 lakhs. Okay, right. Now let us move to the next entry. Friends, the next entry is equity shares 2 rupees to each. What is the equity share value right now? Equity share is at 10 rupees. Something which is at 10 rupees is reduced to 2 rupees. Something which is at 10 rupees is reduced to 2 rupees. Something worth 10 rupees is at 7,50,000 and that is reduced to 2 rupees. How do we do this calculation, my dear friends? If 10 is represented by 7,50,000, 2 is represented by how much? 8 is represented by how much? Now, one small question. Is 10 rupees share, if you say 10 rupees share written down to 2 rupees, are we saying 8 rupees is the, how much is the amount of reduction? Is the amount of reduction 8 rupees or is the value of share after writing off 8 rupees? I am repeating. Is amount written off 8 rupees or is the new value of share 8 rupees? Which of the two is correct? Okay, good. So there are still a few people giving mixed answers, but friends, amount that is written off is 8 rupees. New value of share is 2 rupees. That's what it says. Written down to means the new value of share is 2 rupees. Okay, right. So please understand how to read the problems carefully. It is simple English, but you need to be careful. It does not require you to be it does not require you to be a genius in English, but it requires you to be an alert and attentive student while reading the problems. Okay, right. So now 8 rupees foregone. So out of 10 rupees, we are basically saying 8 rupees gone, 2 rupees still left. So 8 rupees that are gone means 6 lakh rupees gone. Out of 7,50,000, 6 lakhs gone, and 1,50,000 is still there. So what will be the journal entry? The equity share capital, whatever is there, that account debited. 10 rupees account debited 7,50,000. To capital reduction 6 lakhs. To equity share capital rupees 2 account 1,50,000. So I hope next time when you see a problem of internal reconstruction, slow down a bit, check that point. Is it reduced to or reduced by? Okay, right. So I'll just, this is one alert that has to come into you when you're solving problems of internal reconstruction. Now, let us move to the next one. Of the preference share dividends, which are in arrears for 4 years, 3/4 to be waived and equity shares of 2 to be allotted for the remaining quarters. Tell me, what is the total amount of arrears of preference share dividend? Total amount. What is the total amount of arrears? Karthik, entry for which one are you talking about? Yeah. For others, what is the total amount of preference dividend? Okay. Rama Sesha Gopal, 96,000. That's the right answer. That's the right answer. Yes, yes. So it is basically 1 year's preference dividend is 24,000 and it has been in area for 4 years. So 4 years, 24,000 into 4, 96,000 is the total arrears. Okay, right. Now out of 96,000, what is the question saying? Of the preference dividend which has been in arrears for 4 years, 3/4 will be waived. Okay, and 1/4 will be, for 1/4 you are giving equity shares of 2 each. Right. Tell me, friends, for 3/4 entire 100 represents basically, or total dividend accumulated is in arrears is 96,000. 3/4 of 96,000 is 72,000. 3/4 of 96,000 is 72,000. So 72,000 which is in arrears is foregone. Please tell me what entry should we write for that? What entry should we write for that? Array? No entry for waiver. I'm talking about 72,000. What entry should we write? No entry, no entry. You're also acting like police. Everywhere, no entry boards. No entry. No entry. No entry. No entry. Arey yaar. No entry. Everybody seems to be very strong and firm. Sir, lockdown तो continue करेंगे sir और थोड़े दिन. Aha. Okay. Okay. Great. You're spot on, my dear friends. We don't have to write an entry for it because it was not recorded earlier. If it was not recorded earlier, where would it appear? Do you mean to say it will not be appearing anywhere? Will it be appearing anywhere in the financial statements? That arrears of preference dividend, will it be appearing anywhere in the financial statements? I want to hear from people. You're saying there is no entry because it is not recorded. Krishna Kumar says no. Salman says notes. Krishna Kumar, did you say no, or before typing notes, did you enter because of which it is just appearing as no? No, sir, but in contingent liability. It is an unrecorded liability. Gopal says it is contingent liability. Notes. Okay, right. Okay. Friends, it would have been given in the financial statements in the notes to accounts. So, in the notes to accounts, there would have been arrears of fixed cumulative preference shares, arrears of dividend for fixed cumulative preference shares. Those arrears will be given only in such cases. So for fixed cumulative preference shares in that arrears category, you need to look for this. Okay, right. So and that you are basically cancelling. So in that notes, it will no longer appear. And for these 24,000 which are now being settled, 24,000 which are being settled, how do we deal with this? How do we pass a journal entry for that settlement? Can anybody tell me? How do we pass a journal entry for it? Earlier, we created, imagine you created this. This is the capital reduction account. Okay. Earlier, you put in the capital reduction account something on account of equity shares, then something on account of preference shares. So there is a contribution which went into capital reduction account because of equity shares, because of preference shares. Now, my question to you is, when you say you have to issue equity shares, you are issuing equity shares out of what? Out of what are you issuing these equity shares? Out of capital reduction only, right? Now, when you issue equity shares, please remember, can I say I will issue equity shares out of this, or I will issue preference shares out of this? Do I say that? I'm repeating this question. Please understand carefully. I transferred into capital reduction account. I hope you're able to see. This I'm calling capital reduction account. In this, earlier, first I transferred a journal entry for preference. Something came into this. Then 3 lakhs came in. Then 6 lakhs came in when we transferred this out of the equity shares. Okay, 3 lakhs, 6 lakhs are there. Okay. Now my question is, when we have to issue equity shares, out of the equity share related transfer into this, can I issue equity shares, or out of the total whatever is there in this, can I issue that much of equity shares? This is a very important point. I want you to think correctly about it and answer. Is it out of total or equity share portion to equity share issuance? That is the main question. Sir, why are you asking all these questions? These kind of questions are complicated. They are making us think a lot. But it is better to think now than think in the exam hall, which is more dangerous. Okay. Out of total. Excellent. Okay, right. Friends, once I put this and say, out of preference capital, I put something into this, over. It lost the identity of preference capital, or it came out of preference capital. It will lose connection with the roots, over. It is just a part of capital, reduction account. Similarly, out of equity shares, the transfer, whatever I put into this, once it comes into this, no longer I need to say, ye paise equity shareholders hai. No, over, done. The total is what you have. Out of total, you are doing. Okay, right. So that also means this total, whatever I have, can I issue out of this total new equity shares? Yes. Can I issue out of this new preference shares? Yes. For full value, can I give? Yeah, all that you can do, whatever you want, you can do. But basically, the point is, once something comes into this, it no longer, only while coming, it will have the identity of I came from so and so place. But once it comes into this total is available for writing off accumulated losses, for issuing new shares, etc. in cases like this. Okay, right. So is this important point clear to everyone? Can I move into the, okay, can I move to the next point, please? Yeah. Great. Wonderful. Okay. Now, moving ahead. So here, equity shares we are issuing. So equity shares. Okay, there is somebody who has been constantly messaging. I think Mr. Tirath Shah, please message Indigo Learn on the WhatsApp number and you can get more details. Okay, right. Now, here, or you can even contact through the app. Right. So what is the journal entry, friends? Here we are issuing equity shares. The journal entry for that is capital reduction account debited to equity share capital. Capital reduction account is debited because to that extent it is reduced and equity share capital is getting created. Okay, right. Now move on. Accrued interest on debentures to be paid in cash. What is the accrued interest on debentures? Look at the question. There is accrued interest of 22,500 that is paid in the form of cash. I think that is a straightforward entry. Accrued interest account debited to cash. So that can be, that's a more straightforward entry. I'm not spending much time on that. Then look at other adjustments, what you have here. Debenture holders. Very important. Very important. Simply write off of assets and all. I don't intend to spend much time on those. Writing off assets, all that loss, you will come and net it off against capital reduction account. That much all of us know. But now let's spend some time on this debentures point. My dear friends, I want everybody to concentrate 100% on this debentures point. It is another important aspect, a common area where in internal reconstruction we make mistakes. Right. Now look at this point. Read carefully what that says. Debenture holders agree to take over freehold property, book value 1 lakh, at a valuation of 1,20,000 in part payment of their holdings, and to provide additional cash of 1,30,000 secured by a floating charge on company's assets at an interest rate of 8% per annum. 100% concentration on this adjustment. I will read that slowly. It's actually, we have to unpack that a little. Debenture holders agree to take over a freehold property whose book value is 1 lakh at a valuation of 1,20,000. So first and foremost thing, there is an upward revaluation. There is an upward revaluation in the asset. There is an upward revaluation in the asset. Is everybody clear about this point? There is an upward revaluation in the asset. Okay, right. Now, just put a pin on this. continue a little further, come to, just scroll down and come to this point number 8. Remaining freehold property to be revalued at 3,87,500. Okay, you see that point also. So friends, please pay attention. First, we need to ascertain the upward revaluation. Let's do an adjustment regarding that. Then we will come to debentures adjustment. Okay, without doing upward revaluation, you cannot do the debentures adjustment. So first, we need to do upward revaluation. So what I'm hoping you're understanding when we are discussing these problems is the sequence in which you should think about these problems, the way in which you should approach these problems. Right now, come on, look at this. The total book value of the assets, freehold property, what we have is 4,25,000. That 4,25,000 now has two parts. 4,25,000 has two parts, 1 lakh and 3,25,000. This 1 lakh is revalued to 1,20,000, and this 3,25,000 is revalued to 3,87,500. Are you clear about this? 4,25,000 is split into 1 lakh and 3,25,000. This 1 lakh is revalued to 1,20,000, and this 3,25,000 is revalued to 3,87,500. So if you look at the total, total, you see that there is an upward revaluation of 82,500. So what should we do, my dear friends? That upward revaluation, fixed assets are upward revalued, right? So to that extent, basically fixed asset account, freehold property will debit, and correspondingly will credit the capital reduction account. Okay, right. After solving this entry, or after passing this entry, we will go into debentures adjustment. Is everybody absolutely clear about this? Yeah, right. I'm assuming so. Moving ahead in the interest of time. Now, debenture holders are given this freehold property. So then we are saying 6% debentures account debited to freehold property worth 1,20,000. Okay, right. So even after they are given away a property worth 1,20,000, what is the balance value of the freehold property that is still left? The balance value of the freehold property that is still left is 3,87,500. I hope now it starts making sense. Okay, that is still there in the balance sheet. We haven't done anything with that. Okay, right. Continue. Now, in addition to this, they are giving fresh money of 1,30,000. 1,30,000 if they are giving, bank account debited to the debentures. The debenture is what? It's 8% debentures. Bank account to 8% debentures, 1,30,000. Right. So then I'll just skip a few points like patents, goodwill written off, inventory written off, amount provided for bad debts. All these, assets written off means assets will be credited, and what will be debited? Capital reduction account will be debited. Capital reduction account will be debited. All these assets will be credited to that extent. Okay, right. Investments, trade investments sold for 1,40,000. What is the value of trade investments that is given in the question? Trade investments are at 55,000. Now they are sold at, as given in the question, at 1,40,000. So there seems to be some good news here. There is a profit on sale of trade investments to the extent of 85,000. So bank account debited 1,40,000 to trade investments 85,000. Now hold on, there is an important catch here. Normally we would have written to profit on sale of investments bracket transfer to P&L. This is what we would have written. But this profit is under a scheme of internal reconstruction. Okay, that is why this profit will not separately be credited to P&L. This profit also will be credited to capital reduction. Important point. Remember, watch out. You have to revise. These are some key things what you need to revise multiple times so that they become more natural to us. Right. So if you just by heart, you'll be like, whenever there is profit, the profit has to go to capital reduction. No, you have to understand. Why is that profit going to capital reduction? It is going and getting credited to capital reduction account because this profit or profit on sale of investment is under the scheme of internal reconstruction. Under that scheme, we made this profit. That is why this profit is credited to capital reduction account. Now, the next aspects, again, so something like director's loan. Yeah. So director's loan is one other important adjustment that I wish we pay attention and figure out. After which I think other points are not significant. I mean, and capital, you have capital commitments. I think those are the two small points. If we cover them, then we can say we covered most of the key aspects of the internal reconstruction. So here, when you talk about this director settlement, look at this. Directors to accept settlement of their loan as to 90% thereof by allotment of equity shares of 2 each, and as to 5% in cash, and the balance 5% being waived off. My dear friends, if this question is asked in the exam, if I have to pinpoint and pick up only one area where maximum mistakes would be made, it would be this point. Okay, this would be the area where maximum mistakes would be made. Okay, right. By just looking at this, without I'm trusting you don't have to answer by posting in the comment, but you just once think for yourself. You think for yourself what would be the journal entry that you would write for this adjustment regarding director's loan. Then we will now discuss the adjustment. Come to the amount of director's loan. Director's loan is for 1 lakh. That amount of director's loan, the question says 90% is allotted, is settled by allotment of equity shares, 5% cash, 5% waived off. Now tell me, how much out of 1 lakh should be transferred to capital reduction? How much out of that 1 lakh should be transferred to capital reduction? I want to hear answers from you people on this for this specific question. Out of that, how much should be transferred to capital reduction in director's loan? 1 lakh is the amount. How much should I transfer to capital reduction? Fast. Fast. Okay. So we have some answers out there. We are saying 5,000. Okay. 5,000 should be transferred to capital reduction. Karthik, I don't know how to where you pulled off this 9,000. I don't understand where it is. I'm just assuming it is a typo. Okay. So 5,000 you're saying should be transferred to capital reduction. Okay. Right. Friends, I will talk about how this problem is solved in this specific question, and how in some other aspects of study material another approach is followed. Both are correct. Okay, in study material and some other practice problems you might see another method also. Both are correct. I will talk about both. Please pay attention and understand how this is solved. Basically, 1 lakh of liability, you paid off 5,000 rupees in cash. Excellent, straightforward. Okay, right. For the balance 95,000, you're saying 5,000 rupees foregone. Okay, fine. That also straightforward. To capital reduction 5,000. Okay, right. Now, to equity share capital, you are in this problem, you must be saying, sir, 5,000 paid off in cash, 5,000 foregone, 90,000 paid off in the form of equity share capital. Okay, right. Excellent. I don't have a problem with this. Right. Now, the other way in which you might find in some of the institute's material and past problems, you would have seen an approach like this. That approach is director's loan is debited to the extent of 1 lakh, to bank 5,000, to capital reduction 95,000. Listen carefully, it's not over. To capital reduction 95,000. So with this entry, how much did you credit to capital reserve in this model? To capital reduction 95,000. Okay, right. You credited 95,000. Then you will pass another entry. Out of this capital reduction, you will freshly issue equity shares to the extent of 90,000. Capital reduction account debited to equity share capital 90,000, 90,000. Now tell me, in capital reduction account, earlier how much did you, in the previous entry, how much did you credit to capital reduction? 95,000. In the second entry, how much are you debiting to the capital reduction account? You are debiting 90,000. So if you see, net of 5,000 is debited, is credited to capital reduction. So in both these ways, problems can be solved in the examinations or even in the suggested answers, etc. So you should not be surprised. You are understanding that the net impact on the capital reduction account is same. Credit 95, debit 90, net impact is 5,000, or just credit 5,000 only to the capital reduction account. Both these approaches are acceptable. My dear friends, is everybody clear about this? Both approaches. Okay. Suddenly, when you see that problem solved in some other way in a material or practice manual somewhere, you shouldn't be surprised. That is why I discussed both these. Is everybody clear about both the approaches and that slight difference? Yeah? Right. Okay. Excellent. Now, as we kind of wrap up this problem, now we have the last adjustment, which is, or of course, effectively the last adjustment. There were capital commitments amounting to 2,50,000. These contracts have been cancelled with 5% penalty. So capital commitments are at 2,50,000 capital commitments. I am cancelling. What entry should I write for 2,50,000, my dear friends? Come on, fast. Tell me. I am cancelling 2,50,000 commitments. What entry should I pass for cancelling the commitments? Will commitments sit on the asset side of balance sheet or liability side of balance sheet? Where do they sit? अरे ये तो हद हो गया. Again you are saying no entry. Huh? No entry. Ah, Jagannath, you are my friend. Liability he is saying. Commitment, sir. Commitment, come on. इतना तो आपको इतना भी समझ में नहीं आया तो कैसा करके पूरे. अच्युता भी बोल रहा है कि liability side में है सर, liability side. हाँ. Mantesh Gowda Patil is also saying liability side. No entry. Do you understand why on these specific points I kind of pause and I get all of us to think about these things once again? Right. Now, listen. Capital commitments, just like that preference dividend, will not appear in the balance sheet. It doesn't appear on the liability side. Please understand, it does not appear on the liability side. It appears in the notes. Capital commitments. The capital commitments, when we are cancelling, you are not cancelling a liability. Because you are not cancelling a pre-existing liability, you don't have to record for that entire value of 2,50,000. Are we clear about this? It is not a liability. It was not a pre-existing liability. That is why we are not recording that. That is why we don't record that in the balance sheet. But it would have been shown in the notes to accounts. That capital commitment would have been shown in the notes to accounts. And now when we are cancelling that, from notes to accounts, the 2,50,000 you will remove. Please understand. From the notes to accounts, you will remove 2,50,000. And this you are paying 5%. 5%, some 12,500 rupees you are paying. So 12,500 rupees you are paying means to cash or bank. Basically, that amount is going out. Which account will you debit? If you don't know which account to debit, you have this beautiful account called capital reduction. So capital reduction account will be debited to the cash or bank. 12,500 is settled. Okay, right. Now, please, of course, all those losses you would have debited to all the asset reductions and all you would have debited to capital reduction. Now, friends, please pay attention. Like now we are wrapping up the capital reduction account. All story over. Capital reduction, if you still have some balance left in the capital reduction account. Imagine I accumulated some 100 in the capital reduction account. I wrote off this, I wrote off that, all that is there. Still, out of 100, something is left. For 5 rupees left in the capital reduction account. What will happen to this? Everything is settled, only 5 rupees is left in the capital reduction account. What will happen to that? What will happen to that? Bolo yaar, fatafat bolo, we are wrapping up. We are wrapping up the session. What should be done? You are saying, sir, we should transfer it to capital reserve. Acha. So this should be transferred to capital reserve. Whatever is left, we should transfer to capital reserve, we are saying. Now, transfer to capital reserve, transfer to capital reserve, transfer to capital reserve. Very good, very good, very good. Okay, right. What do I mean by transfer to capital reserve? Credit side, we had 100. What we wrote off is 95. 100 on the credit side, 95 on the debit side. On the debit side, we still have something left. Some 5 rupees is falling short on the debit side. Okay, that we are transferring to capital reserve. So you may say to capital reserve. To capital reserve. In the capital reduction account, you may say to capital reserve, you will transfer. Okay. In the capital reserve account, basically, it is becoming a credit balance. Okay, right. Now, roles reverse. Let us think of the other scenario. Sir, this scenario. Now, come on, let us think about it. Here you have 95, you have 100 on the debit side, 95 only on the credit side. 100 on the debit side, 95 only on the debit side. Now what will happen to that 5? What will happen to that 5? My dear genius friends, please answer fast. I am waiting for your answer. There is a last question. After this, we'll go home. Oh, sorry, we are already at home. We will go to the other room. Started. Answer started. Goodwill. Court will not approve. Use P&L or capital reserve. There will be no case as such. You understand why we spend time on some important things like this? Look at the range of answers. Goodwill, then court will not approve. Use P&L, capital reserve. There will be no case as such. Goodwill. Friends, what is the correct answer here? Listen. Utilize capital reserve if it is already there in the balance sheet. Okay, I don't have capital reserve. What do I do in life? Listen. I love that answer. Who gave that answer? Anand Kumar gave that answer. Friends, court will not approve a scheme where you don't, if you don't have adequate sources to clean up these losses, etc., court will not approve that scheme. Okay, so that answer is right. So this case is theoretical. This case generally, ideally in real world, this cannot happen. Now, that said, you may say, sir, exam, what if this comes? For any reason, if it comes in exam, you may just write it as goodwill and close it. You should know the correct answer. Okay, so that's a wrap on our amalgamation internal reconstruction related revision. So I'll just wait for 5 more minutes to hear your feedback, to find a way to improve these sessions. How did you find the session? So specifically 2 things. How did you find the session? Do you have any ideas to improve the quality? Thanks, Sivin Michael. Please reopen chapter-wise sale on FinApp. I'll pass on the feedback to the team. Way of teaching is good. Thank you very much. 100% super revision class. Thank you. Thanks for revision. Waiting for first group accounts. Wonderful revision. Please make live videos for partnership for old syllabus. Thank you. So thanks. Love the way you teach. Thanks, Jayamani. Ah, all right. Thanks, Ramasesha Gopal. Three problems of amalgamation in the upcoming days. Okay. We solved like a lot of problems of amalgamation in our classes. So you can just look up those videos and you have a lot of problems, Karthik. You can look, you can go through those because we spend a lot of time on concept building. So these are more of revision classes, but we spend a lot of time on concept building. So I just don't want to solve any class randomly, pulling off from say out of nowhere. So this internal reconstruction is a little different, where you can actually understand the concept by looking at a problem too. But otherwise, we'll try our best. We'll see how we can do the how we can solve a few problems. I'll bear that feedback in mind, but let's see to what extent we can make it work. Make another sessions for revision of accounting standards. Okay, maybe Karthik just write in the Indigo Learn OneFin forums if there are any specific questions or specific standards that you really want revision for, and maybe then we will find a way to get these. Okay, you find make short videos for RTPs. We did cover RTP related video. I don't know what you mean by short video though. Explanation is useful. Okay, thanks a lot, Vindhya. Thanks. Glad that you're liking it. All right, guys. So this is a wrap on the session. A couple of quick points. You know very well that we put in our heart and soul into making learning fun, engaging, and very valuable to all our students like you. So this works well when each of you becomes the person who spreads the word about Indigo Learn. Indigo Learn does not have hoardings, or Indigo Learn does not have like buses going with its names, but Indigo Learn believes that each student is each student is the person who should talk well or bad about Indigo Learn. No one else has a right to talk about how good or bad we are, right? So you are the people who are getting to experience the effort what we are putting in. You people are the ones who are getting to experience the quality what we are offering. So if there are imperfections, you are the ones who are correcting us. You know very well what's going into this process. So if you really like this effort, if you really like what we are attempting to do through Indigo Learn, please spread the word. You can take to social media and share a small, you can share a note, or you can share a video. You can on WhatsApp status, or Facebook, or Instagram, or Twitter, wherever you are active. Just spread the word, or in any of the Telegram groups, or WhatsApp groups that you're a part of. Just share this effort, what's happening, and share your recommendation about Indigo Learn to your other friends, because this is a great way in which, along with you, many more students, hundreds and thousands of students can get benefited. And we wish to reach someday every CA student possible, right? So from that point of view, please do your bit by helping us spread the word, all right? And secondly, be sure to stay safe and take care of yourself. And we'll come out of this COVID well, successfully. And for all of that to happen, stay safe, stay at home. Take care, my dear friends. Thank you very much. Bye-bye.